The government made two major policy announcements in the first week of February 2022, the Union Budget and the monetary policy. In both, it almost pumped the growth fist, but tried to mute three frightening realities which are looming over India's economy. One, spiking interest rates and bond yields, which have been spooked by the government's astronomical increase of 5 lakh crore rupees. 5 lakh crore rupees, a full 50% over the previous year in gross borrowings. Two, a crashing rupee, which has now gone beyond 75 to the dollar. And three, spiraling oil prices, which are now dancing perilously close to $100 per barrel. Now, inexplicably, the finance minister declined to welcome nearly 2.5 lakh crores. That's $30 billion. Yes, $30 billion that would have gushed in had she altered the capital gains tax rules to permit India's treasuries to feature in global bond indices. As sort of missed opportunities go, it was, I would call it, the queen of times. But honestly, just a couple of other smart moves can significantly alleviate this stress. But for that, our rice in our hill, our finance ministry bureaucrats must stop cowering. They almost cower in irrational fears when it comes to dealing with dollar markets, US dollar markets. Now, these two actions are: action one is that we must boldly go forth with sovereign dollar bonds. Now, remember 6th of July 2019, when the first budget of the second Modi regime was presented, when the same finance minister had gleefully announced a $10 billion issuance of overseas government bonds. But then, unfortunately, she scuttled it, scared by a volley of what I call uninformed criticism. If she were to revive that bold idea, it would be a very prudent, just a very prudent 5% of the government's gross borrowing program, and a mere 1.5% of our foreign exchange reserves. Now, in one stroke, the government would move the foreign currency risk onto its own fiscal accounts. It would, spread joy, literally, in domestic bond markets, and that would create lower local interest rates. Of course, the finance ministry will have to develop, sophisticated foreign risk management skills that would be required to hedge the dollar and launch very nimble treasury operations in international currency markets. Yes, it could be risky during times of capital flight, but precisely because it's difficult and risky, it's entrepreneurial, and therefore it's pregnant with exciting possibilities and gains. Unfortunately, I can already hear the naysayers. But let's debunk each objection one by one. Let's look at objection A. Volatile dollar and rupee rates will create unquantifiable, they call it unquantifiable costs in the long term. Now, here's my counter. This is wrong. By paying a premium of 5% to hedge future dollar rates, our costs will forever be controlled and quantifiable. While the hedged interest rate would be perhaps a few basis points higher than what the government could borrow at in local markets, these shall get compensated by the several positives that accrue on venturing overseas, including the fact that private borrowers in India will get more cash in the domestic bond markets. Now, here's objection B. Why go overseas when foreign portfolio investors, FPIs, can now take 1 lakh crore of additional rupee debt in the domestic market? And once again, here's my counter. This one is actually specious, because when you float a sovereign bond overseas, you access an entirely new category of lenders, which are over and above FPIs that are authorized to invest in India. Here comes their objection C. Foreign investors could indiscriminately dump our bonds, creating a run on the rupee and importing contagion. Here's my counter. This one again is false. Since the bonds will be denominated in dollars and traded on overseas exchanges, any dumping would not directly impact the rupee or domestic markets. In fact, the alternative that is being given of increased FPI exposure to rupee bonds creates exactly the dumping risk that is being wrongly attributed to dollar bonds. And now here's the second action that the finance minister should be taking. She's already told us just very recently that they will be selling only 5% of the LIC stock in the domestic markets on NSE and BSE. Now, since LIC could be valued at anywhere between 150 to 200 billion dollars, that's about 10 to 15 lakh crores, it's obvious that she could raise between 50,000 to 75,000 crores in the domestic market. However, many in the government also doubt the ability of Indian markets to absorb over 1 lakh crore in one shot. Therefore, there is talk that they will break up this offer now in two tranches of 50,000 crore plus. Sort of we'll sell first, then we'll digest, sort of burp, and then we'll sell again. Now, I think we need to think a little bit more out of the box. We need to think a little bit more bold here. Why should we slice LIC's offering in two tranches, which are separated by several months, simply because we are scared our local investors may not have enough appetite? Instead, why don't we sell half the issue, that's 5%, in India, and simultaneously sell the other half, the other 5%, overseas? Now, that could raise close to $10 billion, 10 billion additional dollars on the London Stock Exchange and the New York Stock Exchange. Now do the arithmetic one more time after all the actions that I've spoken about. $10 billion could come from sovereign dollar bonds. Another $10 billion could come from the offer of 5% of LIC stock on London Stock Exchange or the New York Stock Exchange. And $30 billion could come from a tweak to the capital gains tax rules, which will allow Indian treasuries to be a part of global bond indices. Bingo! $50 billion will flow into India. Bond yields will soften considerably, and the rupee will appreciate, become stronger against the dollar. Therefore, we don't need to be desperately silent in our budget or monetary policy speeches if we do these three things.